Benjamin Graham, 1894 to 1976, was a British-born American investor, economist, and author who is widely considered the father of value investing. He is best known for his seminal book, The Intelligent Investor, which has been widely acclaimed as one of the most influential investment books of all time. Graham's investment philosophy emphasized the importance of fundamental analysis, margin of safety, and long-term investing, and has had a profound impact on generations of investors. The stock market is a voting machine in the short run and a weighing machine in the long run. Graham believed that in the short term, the stock market is driven by emotions and speculation, causing it to fluctuate frequently. However, over the long term, the market tends to reflect the underlying value of the companies in it. For example, a company that consistently generates profits and grows its business is likely to see its stock price rise over time, while a company that consistently underperforms is likely to see its stock price decline. In the short run, the market is a mechanism for transferring wealth from the impatient to the patient. Graham believed that investors who have a long-term perspective are more likely to be successful than those who focus on short-term gains. When the market experiences short-term volatility, patient investors can take advantage of the opportunity to buy quality stocks at a lower price. Over time, the patient investor can benefit from the compounding effect of holding high-quality stocks. The intelligent investor is a realist who sells to optimists and buys from pessimists. Graham believed that successful investors should be able to detach themselves emotionally from the market and make decisions based on rational analysis of the underlying value of a company. In practice, this means buying stocks when they are undervalued and selling when they are overvalued. When the market is driven by optimism, it may be a good time to sell, and when it is driven by pessimism, it may be a good time to buy. The investor's chief problem, and even his worst enemy, is likely to be himself. Graham believed that investors often make poor decisions due to their own emotions, biases, and lack of discipline. Successful investing requires self-awareness, rationality, and discipline. Investors should be aware of their own limitations and biases and work to overcome them. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Graham believed that investors should be confident in their own analysis and not be swayed by popular opinion or the behavior of the crowd. Successful investing requires independent thinking and the ability to identify opportunities that others may overlook. The investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. Graham believed that investors should be prepared for market downturns and not panic when they occur. When prices decline, it can be tempting to sell out of fear, but this can lead to missed opportunities for long-term gains. Instead, investors should maintain a long-term perspective and use market downturns as opportunities to buy quality stocks at a lower price. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. Graham believed that investors should always look for a margin of safety in their investments. This means buying stocks at a price that is lower than their intrinsic value, reducing the risk of losses due to market volatility. By purchasing stocks with a margin of safety, investors can protect themselves against unexpected market downturns and still achieve long-term gains. The investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. Graham believed that investors should be prepared for market volatility and should not be swayed by short-term fluctuations in stock prices. Instead, they should focus on the underlying value of the company and its long-term growth potential. This means that investors should not be concerned about temporary drops in stock prices or become overly excited about short-term gains. Rather, they should maintain a long-term perspective and focus on the fundamentals of the company. Investing is most intelligent when it is most businesslike. Graham believed that investing should be treated as a business, with a focus on the underlying financial performance of the companies being invested in. Investors should approach investing with the same level of discipline and rigor that a business owner would approach running their company. This means conducting thorough research, analyzing financial statements, and making informed decisions based on the company's fundamentals. The investor who permits himself to be unduly influenced by the ups and downs of the stock market will be tempted to speculate rather than to invest. Graham believed that investors should not be swayed by short-term market trends or try to time the market. Instead, they should focus on long-term value and invest in companies that have a strong track record of financial performance and potential for growth. By taking a disciplined, long-term approach to investing, investors can avoid the pitfalls of speculation and achieve sustainable returns over time.